The IRS has a tax trap built directly into the system that most Americans won't discover until it's too late to do anything about it. And right now, in 2026, millions of retirees and pre-retirees are about to walk straight into it. This isn't about cheating on your taxes. This isn't about an audit. This is about rules that are already written, rules that will silently transfer tens of thousands of dollars from your retirement savings to the government, whether you planned for it or not. In the next 10 minutes, I'm going to show you the 3 hidden tax traps that are draining American retirement wealth right now, and the 3 moves you can make today to protect yourself before the window closes. Let's start with the biggest one: the retirement tax time bomb. If you have a traditional 401k or a traditional IRA, here's what most people don't fully understand. You didn't pay taxes on that money when you put it in. That was the deal: defer taxes now, pay them later in retirement when you'll be in a lower bracket. Except millions of Americans are discovering that retirement doesn't mean a lower bracket. It means a different trap. Here's how it works. At age 73, the IRS forces you to start taking money out of your traditional retirement accounts. These are called required minimum distributions, RMDs. The amount you must withdraw is calculated based on your account balance and your life expectancy. And here's the problem: retirement account balances have grown enormously over the past decade. A person with $700,000 in a traditional IRA at age 73 must take out roughly $26,000 in year 1. With $1 million, that's nearly $37,000. With $2 million, which is not unusual for someone who saved consistently, that's over $73,000 in mandatory withdrawals every single year. That income gets added to your Social Security, your pension, any other income you have, and suddenly you're in a tax bracket you never expected to be in retirement. But it gets worse. The second trap is called IRMAA. Most Americans have never heard of it. They find out about it the hard way when their Medicare bill arrives and it's 2 to 3 times what they expected. IRMAA stands for Income-Related Monthly Adjustment Amount. It's a Medicare surcharge that kicks in when your income exceeds certain thresholds. In 2026, if your income exceeded $97,000 as a single filer, you paid a higher premium for Medicare Part B and Part D. The highest tier adds nearly $400 per month to your Medicare costs per person. That's nearly $5,000 per year in extra healthcare costs, on top of everything else. Here's the trap: Medicare looks at your income from 2 years ago. So if you had a high-income year, a Roth conversion, a business sale, a large RMD, 2 years later, you get hit with IRMAA. And by then, it's too late to change anything. This isn't a small number of people. Over 5 million Americans are currently paying IRMAA surcharges. And the thresholds are adjusted for inflation, but balances and incomes are growing faster than those adjustments. More people get caught every year. The third trap is one that's been building since 1984 and nobody fixed it. Up to 85% of your Social Security benefits can be taxable. That's the law. And it kicks in at income thresholds that were set over 40 years ago and have never been adjusted for inflation. Single filers start paying tax on Social Security when their combined income exceeds $25,000. That threshold was set in 1984. If it had been adjusted for inflation, it would be over $77,000 today. Instead, it's still $25,000. Which means that what was once a tax that hit only upper-income seniors now hits middle-income seniors routinely. Add this to RMDs pushing your income up, IRMAA adding costs to your healthcare, and you have a retirement income picture that is dramatically more expensive than the projections most financial advisors gave you 20 or 30 years ago. This is not bad luck. This is a structural problem baked into the tax code. So what can you actually do about it? 3 moves that matter right now, before the situation gets worse. Move 1: execute Roth conversions while current tax rates last. The Tax Cuts and Jobs Act reduced tax rates significantly, but many of those cuts are scheduled to expire. When they do, rates in most brackets will rise. The window to convert traditional retirement money to Roth at lower rates is open right now. Converting even a portion of your traditional IRA to Roth, paying taxes now at current rates, means those dollars grow tax-free and have no RMD requirements ever. Every dollar in Roth is a dollar the IRS cannot force you to withdraw. Move 2. Build a strategic withdrawal sequence for retirement. Retirement income planning isn't just about how much you have, it's about which accounts you draw from first and in what order. Drawing from taxable accounts early, then traditional retirement accounts, then Roth accounts is a common sequence. But the optimal sequence depends on your specific situation, your income sources, your projected RMDs, your Social Security timing, and your Medicare exposure. A fee-only financial planner who specializes in tax-efficient retirement income can show you the difference between a planned sequence and an unplanned one. The difference is often $50,000 to $100,000 in lifetime tax savings. Move 3. Execute tax loss harvesting in your taxable accounts now. If you have investments outside your retirement accounts, review your unrealized losses. Selling positions that have declined and immediately reinvesting in similar assets lets you capture a tax loss that offsets future capital gains. This is legal, it's common, and it's something every investor with a taxable brokerage account should be doing systematically, especially before end of year. None of these moves eliminate your tax obligation. The IRS always gets paid. But the difference between paying intelligently and walking into a trap without a plan can be the difference between a comfortable retirement and one where you're constantly surprised by bills you didn't see coming. Finance Alert Global exists to show you what's coming before it hits your wallet. Subscribe now. Share this with anyone who has a retirement account because the trap doesn't announce itself. Subscribe. I'll see you in the next alert.